Good afternoon, ladies and gentlemen. Welcome back to the first weekly market review for the month of February. So fast, we are in February already. As usual, today I have with me my co-host, Mr. Gerald Wong. Gerald, how was your weekend?
It was a very busy weekend. I guess the weekend before Chinese New Year, so had to run a lot of errands. Did some last minute shopping. Had to do my spring cleaning. I also had my reunion dinner last night, so it was very busy trying to prepare for all of that, while at the same time actually trying to keep up to date on the markets and prepare today's presentation.
Yes, definitely. A lot of things happened last week. We have the non-farm payroll data. We have the Fed interest rate meeting. So definitely the non-farm payroll data was a blowout number, better than analyst expectation, better than the previous month number. So market actually rallied. And then of course on top of that, Jerome Powell said that there's likely not going to be a rate cut in March. So likely we are going to see that in May, the earliest. So with that, with all that development last week, a lot of things has happened. Market has been quite active. So we'll be able to break down for us what happened last week and what we should look for this week.
Okay, so I will be sharing a bit about the macro as well as some of the companies that reported their results. Today's sharing is for information purposes only and should not be taken to be financial advice. If you find the session helpful, do leave us a review on Google through the links that are provided. And if you have got further questions that you want to be asking us personally, we have a monthly Ask SIAS that is open only to SIAS members. And to join the SIAS member, it will just cost $12 per year or $1 per month. Okay, so we'll start by doing a recap of the markets. What we saw was very strong performance by the US market once again. The S&P 500 closing at a record high, now at 4959, after gaining 1.4% in the past week. Okay, we also saw Dow Jones and Nasdaq continue to climb as well. STI has also recovered a bit with gains of 0.6% to 3,180. So what were some of the factors that led to this upswing in the market? Firstly, we saw very strong jobs data in the US. Okay, so the non-farm payroll data for the month of January, in total 353,000. So this is a very strong number, especially if you compare over the past 12 months, and really demonstrates the resilience of the US economy, even though some investors were expecting recession over the course of the past year. Okay, so still a lot of jobs being created, and that actually helped to drive improved sentiment towards the US market. We also had the Fed meeting last week, the first Fed meeting of 2024, where we saw that the Fed has kept the benchmark rate unchanged at 5.25 to 5.5%. So that was not too much of a surprise, but what actually affected the market more were actually comments made by the Fed chairman, Jerome Powell, that it is quite unlikely that we will see a rate cut in March this year. Okay, so if you recall our previous weekly market review, we have been showing this chart, which would be the Fed meeting probabilities from the CME Fed Watch tool. And in the past, we will have seen that there is a more than 50% probability that the rate cut would come through in March. But when I checked it last night, what I see is that now 62% probability that the rate will still be kept in March this year. And we are looking at potentially the first rate cut happening in May. Okay, and what we have seen with the very strong jobs data is a reinforcement of the idea that, okay, maybe it might be too soon to actually be cutting rates in March, since the economy is still very strong. And if you cut it too early, if inflation actually starts to come back, then that would not actually be a good thing for the US Central Bank. Okay, next we see the performance of the STI. We saw earlier that the STI had slight gains in the past week. We are also in the thick of the result season. So we see that a lot of the key movers are actually companies that have reported their results. Okay, in terms of the top performance last week, continued to be the industrial stocks. If you recall our recap for 2023, Semiconductor Industries, Capital Corp were some of the top performers last year. And what we saw in the past week is that they've continued to do well. Semiconductor Industries gaining 6.8% and Capital 6% after reporting fairly strong full year 2023 earnings. We also saw some of the REITs starting to bounce back. Mapletree Pan Asia Commercial Trust gaining by 3.5% after they reported their latest earnings. Okay, in terms of the worst performers, we have Seatrium down by 3.8%. That was after the company warned that the losses for FY 2023 will be wider than the losses in the previous year due to some write-downs that they have to be doing on their assets. Okay, outside of this, we see some of the China exposed names such as Jardine Matheson, DFI Retail Group, still actually lagging the market. Okay, so once again, I did a quick poll amongst the community on what are some of the questions that you might have and which are the stocks and REITs that you want us to be going through. And the most popular ones were CapitaLand Ascendas REIT, Lendlease REIT, as well as one more that we'll go through, which is Mapletree Pan Asia Commercial Trust. Okay, I know there are a lot of REITs that have reported over the past 1 or 2 weeks. We don't have time to go through everything else like ESR, Logos REIT, CICT. So effectively what we'll do is to just highlight some of the key ones, and we'll find other opportunities to go through some of the other REITs that have also reported their earnings. So we start with CapitaLand Ascendas REIT. This seems to be a very well followed REIT in the market. We have seen that the share price has been still quite resilient at about 290 per share. So I would say this is one of the more resilient REITs in the entire market. Okay, so what we saw is a distribution per unit of 7.441 cents in the second half of 2023. This is down 6% compared to the previous year. And what drove the lower distributions was really the higher interest expense, even though they were able to see an increase in the net property income. Okay, so this is what we see. If you look at the gross revenue, it actually went up by about 11% compared to the previous year due to the acquisition of 3 Singapore properties, as well as higher occupancy in some of these properties. Okay, but if we were to look at the total amount available for distribution, that actually came down, and that is driven by the higher financing costs that they actually had to face. Okay, so the higher interest rate is impacting REITs to different extent, and most of it is being reflected in the higher financing cost. So with that, we see the 6% decline in the DPU to 7.441 cents. Okay, so just as a quick recap on the portfolio of CapitaLand Ascendas REIT, what you see here is that now close to half of their assets will be in business space as well as life sciences. Then you've got significant exposure to industrial and data centers as well. And then lastly, about 25% towards logistics. In terms of the breakdown by geography, Singapore would be the bulk of the assets at about 64%, followed by US, Australia, UK, Europe, each at about 10 to 15%. Okay, so we look at the portfolio occupancy of the different markets. Singapore occupancy has stayed at about 92.7%, so flat compared to the previous quarter. The occupancy came down quarter on quarter for US and Australia, but overall still fairly resilient portfolio occupancy of 94.2% compared to 94.5% in the previous quarter. Okay, if we were to look at the rent reversions, then this is where the numbers have come through fairly strongly. If I were to look at the fourth quarter of 2023, the rental reversions were positive 17%. Okay, And if we are to look at some of the other key markets, US positive 11%, Australia 22%. So we are seeing fairly strong reversions for the assets that they have. So with that, it managed to bring the total positive rental reversions to 15.2% in the fourth quarter and 13.4% for the full year of 2023. Okay, earlier we saw that the distributions were impacted with the higher borrowing cost. What we see for CapitaLand Ascender Suite is that it's got a leverage of about 37.9%. So below the 40% threshold, and that will make it maybe just slightly below most of the REITs. If you look at some of the other metrics, it's got about 80% of the debt now at a fixed rate. So that will once again help to mitigate the increase in borrowing costs. And if you were to look at the weighted average all-in debt cost, as at 31st December, it is now at 3.5%, versus if I were to look at 31st December 2022, that was at 2.5%. So this increase in borrowing costs from 2.5% to 3.5% has actually weighed on the distributions. Okay, if I were to look at the valuation of CapitaLand Ascender Suite, now at about 1.3 times price to book, so quite close to the high in the past and also above the historical average of about 1.1 times. Okay, next we'll look at Land Lease REIT. Again, a REIT that had a significant sell down towards the third quarter of last year, saw a fairly strong rebound back to about 65 cents and has stayed at about the 65 cents level since then. Okay, so distribution for Land Lease REIT, 2.1 cents for the first half of fiscal year 2024. So that's down 14% compared to the previous year. What we see is once again higher borrowing costs, which has actually impacted the distributions. Okay, so if you look at the gross revenue in the first half of fiscal year 2024, up 18%, net property income up by 22%. But if I were to look at the distributable income, that actually came down by 12% compared to the previous year. Okay, so if I were to look at the breakdown of assets for Land Lease REIT, about 88% of the assets in Singapore and 12% in Milan. And if I were to look at the breakdown across the different asset classes, suburban retail / office is about 60% of the portfolio. Prime retail is 28% and Grade A office is 12%. Okay, so if I were to look at the portfolio stats, what we see is actually the occupancy came down. In the first quarter of fiscal year 2024, it was at close to 100%. But going into the second quarter of the fiscal year, that actually came down to 88%. Okay, so what is driving this fall in the portfolio occupancy? Number one, if I were to look at the retail portfolio, that still continues to do very well. GEM 100%, Somerset 313 99%. So the overall occupancy of the retail portfolio is actually still very strong. But what actually weighed on the portfolio occupancy is actually the office part, and that is mainly driven by the performance of the Milan assets. Okay, so what we are seeing for the Milan assets would be some issues with the tenants there, which has actually brought down the overall portfolio occupancy. If I were to look at the borrowing and gearing levels of Land Lease REIT, gearing ratio at about 40.5%. Okay, so above the 40% level and higher compared to what we saw for CapitaLand Ascender Suite earlier. And if I were to look at the weighted average cost of debt, that has also gone up to about 3.37% from 2.94% as at 30th September 2023. Okay, so the higher borrowing cost has actually impacted the distributions for Land Lease REIT, apart from the performance that we see for the Milan office asset. Okay, if we were to look at the dividends for Land Lease REIT, it has come down from the 2022 levels. Based on current consensus forecasts, that will be close to a 7% dividend yield for the FY 2024. So I think if I were to look at where this 7% level of dividend per share, dividend yield is, maybe slightly higher than some of the other retail REITs, but it would have come down from what it was sometime in the third quarter last year when it was actually at 9%. Okay, if I were to look at the price to book valuation of Land Lease REIT, now at about 0.8 times versus the historical average of 0.9 times, but definitely slightly above where it was in the third quarter of last year when it actually fell below 0.7 times price to book. Okay, last but not least, Mapletree Pan Asia Commercial Trust. We saw earlier that it was one of the top gainers in the past week, where the share price actually rebounded after they reported their most recent earnings. Okay, so in the earnings distribution per unit of 2.2 cents for the third quarter ending 31st December 2023, and that is 9% lower compared to the previous year. So the performance of the Singapore portfolio was still very healthy, but this was actually offset by the higher borrowing costs once again. Okay, so if you see the gross revenue was up slightly, the net property income was actually still up slightly compared to the previous year. But if you were to look at the finance costs, that actually increased by 14% compared to the previous year. And with that, we saw the 9% decrease in the distribution per unit. Okay, so if I were to look at the occupancy across the different assets, what we see is that the occupancy across this retail portfolio is very strong. So if I were to look at, say, VivoCity, close to 100% occupancy, other Singapore properties also close to 100%. In Hong Kong, Festival Walk also at 100% occupancy. So actually the retail portfolio is doing very well. But what is dragging this down? Some of the China properties, Japan properties have slightly occupancy. And with that, the total portfolio occupancy is at 96.7%. What we have seen for this occupancy trend is that it's improved over the past few quarters. If I were to look at, say, December 2022, it was at 95.5%, September 96.3%. So as the outlook for the North Asia properties actually continue to improve, we have started to see an improvement in the overall portfolio occupancy for Mapletree Pan Asia Commercial Trust. If I were to look at the rental reversions, that continues to be holding up as well. I'm not sure whether any one of you did your New Year shopping at VivoCity, but VivoCity is doing really very well. The rental reversions that they are getting is 14%. Okay, so this is really the crown jewel for Mapletree Pan Asia Commercial Trust. Okay, outside of that, for the office assets, MBC is seeing 7% rental reversions, so not too bad as well. The rental reversions for Hong Kong and China are still negative. Festival Walk at negative 8%, China properties at negative 3%. But because VivoCity and MBC are doing fairly well, so that has helped to lift the overall rental reversions for its portfolio to positive 4.1%. Okay, next we look at the balance sheet of Mapletree Pan Asia Commercial Trust, gearing of about 40.8%. So like what we see for Land Lease REIT, above 40%, and it's inched up slightly over the past few quarters. They have now about 85% of their debt at fixed rate. And if I was to look at the weighted average all-in cost of debt at about 3.3%, so similar to what we saw for the previous quarter, but higher than where it was in December last year, which actually explained the higher borrowing cost. Okay, so this is the dividend per share for Mapletree Pan Asia Commercial Trust. Once again, we are seeing that investors are expecting it will decline in FY 2024. And with that, Mapletree Pan Asia Commercial Trust is expected to offer a dividend yield of about 6.1%. Okay, If I were to look at the price to book valuation of Mapletree Pan Asia Commercial Trust, also below 1 times, now at about 0.8 times, versus the historical average of 0.9 times. Okay, so I've done the recap of 3 REITs that seem to have decent investor interest over the past week. This week, we still have got quite a number of companies reporting. The REITs, for example, we have got Paragon REIT, CICT, as well as Manulife US REIT. Outside of that, I'm sure a lot of us are looking out very closely for DBS earnings, which is going to be out on 7th of Feb on Wednesday. And then we are all going for a nice break over the Lunar New Year holidays. So quite a number of things that we need to be watching out for before the holidays. And with that, I'll hand over to Sunny, who will share with us how the latest technical trends are actually looking like.
Hey, thank you, Gerald. Thanks for reminding us that this Friday is actually the reunion dinner. So I was at the Chinatown market over the weekend. I don't see much of a crowd, and of course, the discount has not started yet. So maybe on Thursday night, we will go there and grab all the 50% discount goods.
Friday night, not Thursday night.
Friday night is the dinner. Okay, Friday, yeah,
You
after
can go
dinner.
after your dinner.
Yeah, Friday night after dinner, we shall go there and grab the 50% discount. Yes, so thank you, Gerald, for the very detailed sharing on some of the REITs results that was published last week. It's a bit of a mixed bag. Of course, we see some positive rental reversion and, of course, increase in revenue and net property income, which is a good thing. But these results were based on last year, 2023. So the interest expense or the which is still elevated, is still causing a bit of concern. But looking forward, the interest rate environment is still uncertain. We are still not sure when the interest rate will come down. It may stay elevated for some time. So this, if you look at it from a different angle, you can see that some of the REITs have rebounded towards last year. You may still have time to get in on the higher yield that you could be getting right now compared to the other cash product or the interest rate products, which the yield has come down already. So this is something that you can consider. Okay, so let me share my screen to do a recap of what happened in the market. Okay, this is the STI index. As you can see, last Friday, we have that very positive performance, but this morning, we seem to be giving back some of those gains. So last Friday, we were up about 1.17%. For the whole week, as Gerald has mentioned, we were up about 0.6%. So what caused the big jump on Friday was definitely the overnight rally from US, the big tech rally, where we saw some of the big US tech companies announcing their results, and then the results were very positive, especially on Facebook parent Meta, which rise over 20% because they started to give out dividends already on top of the excellent results. So Singapore market on Friday definitely followed that Thursday overnight rally in US, but then today we are giving back some of those gains. Overall, I still maintain my forecast or my opinion that STI will likely still need to pull back towards this zone over here, highlighted in gray, and the support will likely come maybe around this December low that we see before the December rally happened, and that is around the 3,100 points level, around it, or 3,090 points, 3,100 points level. That should be a good support for the STI index. What are the technical indications that we have noticed? You can see that this red line over here, which is the 200 days exponential moving average. So as we all know, 200 days moving average is a very long-term kind of average, and it's also a very strong, it can become a very strong resistance or a support level. And last Friday, when we start to test this level, you can see that the candle actually starts to come back down again. So this is the main reason on the technical front why the STI pulled back today on the index. And if you look at the technical indicators, MACD has been trending down since the middle of January already. And of course, we still have a negative number on the MACD indicator, meaning that we have a negative momentum in the STI index right now. And based on the trajectory, that is likely going to continue. On the RSI indicator, the latest reading is 46, is below the 14 days moving average, as well as below the 50-point neutral mark. That means that the momentum is quite weak as well, and it's unlikely that we will see a big rebound on the STI index. So with the technical indicators of the moving averages of the MACD and RSI signaling to us that market is not ready yet for a big rebound, I still maintain my forecast that we are likely to see further pullback on the STI index until the 3,100 points level. So the setup of the indicators right now also don't encourage traders or investors to go long at this moment. We are not in the oversold position yet. That will be the perfect condition on the RSI. And on the MACD, we will want to look at the MACD line crossing above the signal line as an indicator of a start of a reversal upwards happening. So until these two indicators have signs of those setup, I don't think I will go into the STI index right now. Next, let's look at the major US indices. Of course, Gerald has said we are now at an all-time high right now. So what happened last week was in the middle of last week, Wednesday, we have the Fed chair announcing that or saying that he is of the opinion that we are unlikely to see a rate cut in March. So that's why we got a pullback on Wednesday. After that, on Thursday and Friday, we see the some of the big tech names, some of the Magnificent Seven names reported their earnings, so market rally back up again. So this rally is very much led by the AI and tech boom. So even though you may be in the index, your exposure towards this Magnificent Seven company would be very great. And if interest rate don't come down, that could be one scenario or one trend that could make the index pull back. So like I said earlier, the US indices at an all-time high, I don't feel comfortable on getting in. The MACD indicator is very much neutral, although we do have a positive reading, as you can see, but the trajectory is more towards the sideways direction. Hence, this might be the peak, and it might be range-bound or trending in a sideways direction. That's what the MACD indicator is telling us at least. On the RSI, it's the latest reading at 69. Previously, we reached a bit slightly higher at 72 points in the middle of last week. So this means that we are very close to the overbought level, which means that we may likely see a pullback happen. And if a pullback happens, some of the key levels, 20 days moving average or the Bollinger Band basis, that is at 37,942 points, which is about less than 600 points or 700 points from what we see last week, close of Friday. So this is something that you might want to look out for as the first support level. Of course, this is 20 days moving average. It's a short-term average. It's likely to be a trending support, meaning that the situation or the environment still needs to be on an uptrend for the 20 days moving average support to come in. Else, the next firmer support would be the 50 days moving average, which is the blue line that you see here at 37,100, which is my preferred level of getting into the Dow Jones Index. This now also coincides with the lower bound of that Bollinger Band, which has some confluence and thereby could provide a stronger support or a preferred entry on the Dow Jones Index. If you look over here in the middle of January, once it hit the lower bound of the Bollinger Band, it starts to bounce back up again. So this is a similar kind of setup that I'm looking out for the Dow Jones Index. So I've touched on the MACD indicator and the RSI for the Dow Jones Index. So the setup, as you can see overall, is not the perfect setup or close to the perfect setup that we should go for a long position on the Dow Jones Index. Next, let's move to the S&P 500, all-time closing high again on S&P 500. We are up about 1.07% on Friday itself. So you can see very much peaking above the 20 days moving average and even testing the upper bound of that Bollinger Band. Of course, one of the things that if you are trading the Bollinger Band technical indicators on a long-term uptrend, it may stay very close to the upper bound, and the basis of the Bollinger Band or the 20 days moving average would then be the entry level to look out for if you are a trend trader. Okay, the 50 days moving average, which will provide firmer support, will be around the 4,729 points level. So we are quite about 200 points away from last Friday closing of 4,958 points. Same thing, MACD indicator looks to be telling us that it may likely be range bound and it's quite elevated right now. So we are we're actually looking for further catalysts that could bring the US indices higher. But as of now, I don't think the setup is in our favor yet. On the RSI, we are also starting to get back in above the 70-point overbought level again on the S&P 500. Hence, the indicators right now or the setup right now that we see on the charts are not in favor of us going for a long position. Instead, I would say that having reached the all-time high, when with all the indicators telling us that we are close to the top, it would be more ideal if you have some position to take some profit off the table right now and wait for a slight pullback before getting back in again on the major US indices. Lastly, on the Nasdaq Composite Index, so the Tech Rally Index, of course, will be most most well reflected in the Nasdaq Composite Index, as it is the tech-heavy index. So as you can see, the Nasdaq Composite Index, that's what I have said. We are close to where we see the peak in the January period. So this now you can see that we touch it on the 24th of January, 29th of January, and of course the latest one on last Friday, 2nd of February. So the 15,600 point or the 15,700 points level now could actually be a very strong resistance level that we are looking at, having tested it quite a few times, a few weeks already, and we are unable to break that. So if there is no further catalyst, we may see a retracement happening on the Nasdaq Composite Index. So the drop that you see over here was the announcement that we are not likely to see a rate cut soon. So the earliest was in May. So if the May rate cut does not happen, don't be surprised that the big tech companies will see a further pullback again, and that could be an opportunity for traders to get back in. The MACD indicator trajectory is range bound. The RSI also is still healthy momentum right now at 64 points, but of course very close to the 70-point overbought mark. So do look out for that happening, and that could be a trigger for a pullback on the Nasdaq Composite Index. So this is my take on the major indices on the US as well as on the Singapore side. Final words, Gerald.
Well, so we are going into a final few days before the Chinese New Year holidays. Quite a number of things for us to be looking out for. And I'm sure when we come back for the Chinese New Year version of the weekly market review next week, there'll be a lot of things that we'll be able to share once again.
Yes. So that's all the time that we have for today, but I do not want to forget wishing all of our viewers a very happy Chinese New Year going ahead, and 恭喜发财. Any wishes to say, Gerald?
Yes, I'll have an early 恭喜发财 to everybody, but I'm sure we'll have more of that when we come back for next week's weekly market review.
Okay, that's all the time that we have. Thank you for tuning in to us. If you like our content, do give us a like or a share, and we appreciate you to subscribe to our channel as well for the latest update. Thank you, Gerald, and thank you, everyone.
Thank you.